Hi, today is June the 29th, and we're doing an episode slightly earlier because I know everybody will be dying to go on holiday for the next few days and enjoy Independence Day. So we're doing it today, and then we'll be on holiday too. So, Andy, what happened this shortened week, and what do you think is going to happen the next shortened week?
As we were saying last week, the data that is coming this week was going to be the auctions, which all went very well, interestingly, given what happened today in the bond market. But all the auctions went well. And today we had the jobless claims data and the GDP revision for the first quarter. And
Yeah.
both of those pieces of data were very hot, indicating a strong and growing economy with 2% GDP, which was a revision up from 1.4%, which was a big surprise to markets. And tomorrow we have the PCE, which is the Fed's favorite inflation gauge, and we'll see what that'll be. But the reaction today for the markets was fairly extreme. And interest rates, particularly the expectations of what the Fed is going to do with the Fed funds rate, went up quite a bit, including the long end of the bond market went up as well. And we saw even further inversion, which is consistent with what we've been saying on the our macro outlook for a while. And right
Yeah.
now, two hikes are almost fully priced.
Yeah. Now, let me summarize in detail so people can understand what the market did today. The market got basically, the narrative that we were in recession or that we might be in recession has been kicked down the road a long way by those GDP revisions. And also the fact that a lot of people were speculating over the course of the past 2 or 3 weeks that the weaker than expected unemployment numbers that we kept on getting on Thursdays might be the beginning of a trend. Today, that got completely, with the revisions and everything, that again got completely destroyed as a narrative. So now we have an economy that's growing at 2% real in the past, and we have an unemployment rate which is not dropping, which basically means that demand is strong. We have strong demand, and the only way that the Fed can calm this economy down is by lowering demand. And what does that mean? That means that the market, for the first time since the dot plots came out, 2 weeks ago, is actually beginning to believe the dot plots. And the short end of the curve today repriced to say, yes, Fed, we will no longer fight you. We agree that 2 interest rate hikes for the remainder of this year are appropriate. And basically, the short end has repriced. The the yield curve has inverted further, i.e., flattened, and the 30-year is still in the same range in which it has been all month. On the back of that, equities, and especially bank stocks and growth stocks, have said, this is great. This is Goldilocks. We have strong growth. We have rates at the long end of which we price, which are not going up. Inflation expectations are contained because the Fed is hiking and will continue to hike as appropriate. And therefore, long rates are not going to go much higher. Short end rates might, but even those have repriced to the expectation of 2 Fed hikes. Therefore, it's questionable even how much further they can go. And therefore, we got a rally, especially in growth stocks and in the Dow. And that is what I think will continue to happen for the foreseeable future, because we all agree higher for longer is worse for bonds than it is for equities.
Yeah, and when you say growth stocks, you're not talking about the meme AI
No.
type stocks. You're talking about companies that make things, that sell things, that do services that are going to benefit from very strong economy in the short term. You
as
saw
well as
Russell.
banks.
You saw Russell, for instance, do very well over the last few days, and those are companies that they're not the big tech. They're companies that make stuff.
In fact, today you had the Russell up, you had the Dow up, you had the SPX do nothing because it's in between, and you had the Nasdaq down slightly.
Right.
So that is a trend which could continue. And technically speaking, the Dow has been in a range since November. It's returned zero since November, and it might be time for rotation into the Dow, especially since a lot of the stocks which are in the Dow are financial type stocks. You're talking about the big banks and so on, which should actually do a lot better because credit spreads are remaining tight. They're not going to have, the market is speculated that they're not going to have a lot of bad bad debts like they would do if we went into a recession. And therefore, I think that the big banks can benefit by 5 to 10% here over the course of the next few weeks.
Hmm. Interesting. Okay, so that's what happened last week. A big, and probably happens tomorrow, end of quarter, big rotation into these types of stocks, and a strong growth, which is hurting bonds and helping equities. Next week is July 3rd is we're open. That's going to be Monday in between on a
Nominally.
long holiday and quiet. And then the rest of the week, on the 5th or the 6th, we should get the Fed minutes from their last meeting, and maybe we see some idea better. We got all we're going to get from the minutes with the dot plot, so maybe we get to see some sense of where the Fed is. But based on Powell's talk in Europe with the other central bankers at a panel meeting this week, 50 basis points is priced, 50 basis points is what's going to happen. And it's probably not that interesting. And at the end of the week, we get non-farm payrolls, which is always an interesting number. And expectations are going to have to be really dashed, meaning very negative non-farm payroll, not negative itself, but a low non-farm payroll with a higher unemployment rate for this trend of 50 basis point hikes, inversion, no recession to be sidetracked. So we'll look at that and we'll get back to you at the end of next week after we see that. But for the time being, we think we've been saying high nominal GDP, which is some combination of GDP and which came in strong yesterday, and inflation, which continues to be strong, is going to be better for stocks and worse for bonds. And we continue to feel that way. We replaced all of our long stocks with calls, which seems to be working out fine. We're not missing anything.
No.
And we have actually a higher exposure to equities than we've had in a long time in terms of the notional of those calls with very little risk.
Yeah.
What do you think we should do with the portfolio at this stage?
I think I have a fairly strong feeling that the Dow is going to outperform in the next few weeks, and I think we ought to add some Dow to our portfolio. I have a very strong feeling that the Dow could do something spectacular in the next couple of months, but we shall see.
Yeah, it'll be. So I'm okay with that. I still like the fact that we're at low risk, and if we were to buy some Dow, maybe 35, maybe 100 shares, $35,000 worth, that's what our risk is, along with a couple $1,000s of call premium. Our risk is still low, but our upside grows. And I'm with you on this idea that the transition from very bid up, high cap tech into some more classic companies, the best of the classic companies, with continued exposure in Microsoft and Apple, which are in the Dow, could make some sense here.
That's what I think, and I will do my piece and show what we're doing first thing tomorrow morning.
Just to round out the conversation, bonds, they look like they're going to get weaker, but at some point they may get suddenly weaker. That looks to me to be an opportunity to get long some bonds. We've been staying away from bonds for a while. long-term bonds. But otherwise, our bond position being in tips, inflation-linked securities, and cash with some of the emerging market government bonds in our ETF look fine. I wouldn't change that a bit. And gold and commodities are about where they should be, right?
Yeah. No, I think that if long-term bonds, and I'm talking about 20s and 30s, get to above 4%, 4.05, and start stopping people out, I think that is because a lot of people, don't forget, are very long of bonds
Yeah.
and they could get stopped out. I think they were too early. And if that does happen, I think that's going to be an opportunity to actually buy bonds.
So
So I
gold to
think TLT
405.
somewhere around 98 or something like that. If should it drop down there, I think it's going to be an excellent opportunity to buy. But that is not something for today. That's something for the weeks coming. I don't think that is imminent in the
Right.
next 10 days or so.
Sounds good. Okay, Nick, have a good 4th of July.
You
We
too.
beat you back many years ago, so try to celebrate the best you can.
Will do. Have everyone have a wonderful 4th of July weekend. Bye bye. So this is what I'm going to be doing first thing tomorrow morning on the open. I'm going to be buying 100 shares of DIA. I'm going to be doing it at the market, so don't look at the price. I have no idea what the price is going to be, but I'm going to be buying them tomorrow morning as soon as I can. And tomorrow I will also send out the Excel file with a statement because it's now Thursday when I'm doing this and I don't have the statement because it's going to be produced tonight. So I will send you the Excel file tomorrow. Just so the 100 shares of DJI is about 13-14% of our fund, and therefore that is just a very small increase in our equity position. But as you heard, we think that the Dow stocks are in the best position to do something significant over the course of the next few weeks and months.